This is Milo. One ordinary morning last August, he opened his investing app, and a chunk of his savings had simply vanished overnight. He hadn't sold anything. He hadn't done anything. A central bank on the other side of the world had nudged a single interest rate, and a trade most people have never even heard of came violently apart, dragging markets down with it. In one day, Japan's stock market fell more than 12%, its worst day since 1987. And the shockwave hit New York, London, everywhere. The culprit had a boring name: the yen carry trade. It might be the most important trade you've never heard of, a hidden wire running underneath the entire financial system. So let's pull on it. Here's the whole idea. For 25 years, Japan kept its interest rates pinned near zero. Money was almost free. So traders around the world started doing this: borrow yen for next to nothing, convert it into dollars, and use that to buy things that actually pay a yield: US government bonds, stocks, even crypto. Then pocket the difference. Borrow at 0.5% in Tokyo, earn 5% in New York, and you keep the 4.5% gap for doing essentially nothing. Now pile on borrowed leverage, and that thin sliver becomes a fortune. That same leverage is exactly what makes it dangerous. But we'll get to that. How big is this trade? Honestly, nobody knows precisely. Estimates run from a few $100 billion to several trillion, depending on what you count. The famous 4 trillion figure is really just a guess no one can pin down. But everyone agrees on this: it's enormous. Big enough to move the whole world. And that isn't just Wall Street hedge funds. It's global banks, it's pension funds, and famously, ordinary Japanese households. Picture a retiree we'll call Mrs. Tanaka, quietly shifting her savings into foreign assets for a better return. Millions of small bets and a few giant ones, all riding the same trade. That's the pipe quietly funding markets everywhere. So what changed? After decades stuck at zero, the Bank of Japan finally started raising rates. And in June 2026, it lifted its rate to 1%. That sounds tiny, but for Japan, it's the first real hiking cycle in about 31 years. And yet the yen kept falling, all the way to around 161 to the dollar, its weakest level since 1986, a near 40-year low. Why is it still sinking? Because even at 1%, Japan's rate is still far below America's, near 3.75. That gap is the entire engine of the carry trade. So as long as it stays this wide, the pressure just keeps building. Japan is fighting it. In just 2 months this spring, Tokyo spent a record 11.7 trillion yen, about $73 billion, propping up its own currency. Now its finance minister and the US Treasury Secretary are openly coordinating, hinting at decisive action. When governments start talking like that, markets get nervous. And they should be, because this is not hypothetical. It already happened, in miniature, just last August. The Bank of Japan nudged rates up, a weak US jobs report landed 2 days later, and the yen suddenly jumped. That was all it took. In a single Monday, the unwind tore through the markets. Japan's Nikkei fell 12.4%, its worst day since the crash of 1987. The market's fear gauge, the VIX, spiked to 65, a level seen only in the 2008 crisis and the COVID crash. America's S&P dropped 3% in sympathy. Then, almost as fast, it bounced. The Nikkei posted one of its biggest gains ever the next day, once a Bank of Japan official promised they wouldn't hike into the chaos. A near miss. but it showed everyone exactly how the fuse works. Which brings us to the real question. How does a small rate move in Tokyo wipe out savings in New York? Through a chain reaction, and it's worth watching step by step. It starts when the yen jumps. Suddenly, everyone who borrowed yen owes more than before. Their bets are underwater. Their lenders demand more collateral. That's a margin call. So they're forced to sell, fast. And what do they sell? The very things the carry trade bought. U.S. stocks, bonds, emerging market assets. At the same time, they buy yen back to repay the loans, which pushes the yen up even further, which puts even more traders underwater. Round and round it goes. That's the part to remember. Leverage is the hidden wiring that connects a currency in Tokyo to the retirement account of someone who has never once thought about Japan. When it unwinds, everything sells at once, which is why a Japanese interest rate can ruin a Monday in Manhattan. So why doesn't Japan just fix this? Because it's trapped between two walls. Hike rates too fast, and it triggers exactly this unwind, plus a recession at home. Hike too slow, and the yen keeps collapsing, making everything Japan imports, energy, food, more expensive for its own people. And there's a deeper reason it can't simply raise rates. Debt. Japan's government owes about 235% of its entire economy, the highest in the developed world. Already, a quarter of the national budget goes just to paying interest. Higher rates would blow a hole in its own finances. Japan, quite literally, cannot afford normal interest rates. Now, is this a guaranteed catastrophe? Not necessarily, and honest analysts push back. Much of the riskiest carry was already flushed out back in 2024. Some argue it's a funding shift, not a credit crisis, and that even a large 20% unwind, around $400 billion, is small against a $70 trillion U.S. stock market. The fuse is real. Whether it actually blows is genuinely debated. But here's why the whole world watches anyway. Japan is one of the planet's biggest creditors and the single largest foreign owner of U.S. government debt, about $1.24 trillion of it. When the country that quietly funds everyone else starts pulling its money home, everyone feels the tug. So what do you actually watch? 3 things. The yen around 160 to the dollar, the line where Tokyo tends to step in. The Bank of Japan's next meetings. And that gap between U.S. and Japanese rates. When those move, the carry trade moves. And so can your portfolio. Because that's the real lesson of the great unwind. Some of the biggest risks in finance aren't loud or obvious. They're quiet machines, humming away under everything, that almost no one notices. Until the day they stop. Japan's carry trade has powered global markets for a generation, and nobody is quite sure how it ends. This has been Cat World Order, making the hidden machinery of money make sense. None of this is financial advice. If it helped, subscribe and tell me what to explain next. Thanks for watching.